put a nice little bow on it. And then this presentation will be kind of distributed for you guys. It's kind of lengthy, but want it to more or less be a guide for you guys should you have any like questions and go back and see all that. Let's see. Okay, so first off, we're going to talk about like the fundamentals or the key terms. So depreciation is probably the biggest one. It's basically a paper expense for purchasing the property. It's one of the biggest advantages to real estate, as you guys know. Then an expense, basically that's an ordinary and necessary. Those are like the two things that you need to know. Basically, it's the costs that are in the industry, and then necessary is any cost to fulfill your mission or anything like that as part of the business operation. And then depreciation recapture, basically when you sell a property, you're gonna, you took depreciation, now the government's gonna want it back, and then you'll get taxed on that up to 25%, and we'll talk about a way to avoid that. So we'll talk about the life cycle of a rental property. So first off, you're gonna purchase it. Before that, we all know that it's not the easiest of processes to buy, especially in this market, but once you get it under contract, you buy it. The biggest thing here is just knowing what your basis is. And what basis is important for is determining your depreciation deduction on an annual basis. And why that's important is then you can better like tax plan. So the items that go into basis: purchase price, credits from your seller, which would be a subtraction, title fees, recording fees, attorney fees, any city or county fees. And within the city of Chicago, there's a city of Chicago transfer tax, which is pretty sizable. And then any other costs that you need to purchase property, like scoping your sewer lines. Or for instance, like I had to go to the title company, so I put like my parking of like $20 on there. So it could be a big expense, or it could just be a small expense. But like any due diligence expenses would be good that are for that property. And then once you figure that out, then you have to allocate between building and land. So building is depreciable and then land is not. So there's a few ways of doing it. You can look at your assessor's website, so Cook County or whatever county it's in, or you could look at the appraisal report, and the one of those two ways, whichever way is more advantageous, to shift more to the building, which is depreciable, because that way you'll get more of a depreciation deduction. And then any loan costs you incur is part of it. FHA has quite a bit of loan costs, and then any other things like that. So then I have like some sections that are specific to house hacking. So if you're a house hacker, you have to allocate between the rental portion, which is depreciable now, and your personal part. So for instance, you can allocate mainly in two ways: square footage or bedrooms. So simple example, there's a 10 unit or a 10 bedroom place, and you have a 10 bedroom place, you live in two of them. So you can get an 80% rental or 80% depreciation deduction, or you could do square footage, and assuming it's like all the same, 4 units, 1,000 each, you'd get 75%. So you want to like shift that to be as much as possible, 80%. So the biggest thing to be aware of here is whatever way you decide to go, whether it's square foot, bedrooms, or any other reasonable way, is you have to carry this forward for allocating common expenses, which I'll get to in a minute when we talk as part of the monthly work. Then if you have any rehab, keep track of anything that's additional to the property, and you want to pay specific attention to useful life that's less than 20 years. Think like furniture and fixtures, appliances, or building improvements. And those are kind of the main things. So however, like if you have like a common area, say like you do like a sidewalk or a parking pad, you're gonna need to divvy that up in the same way, basically, that you divvied it before. So if you took like 80%, like for the basis, you would then allocate 80% to this, and then after you move out, you would then take the 20%. So now getting into the monthly work, this will be like probably where a good amount of your time is, assuming you own the property. So big picture is on the right-hand side, you'll see here is Schedule E. This is where you'll report your income and expenses for each rental property. And you'll want to keep track of each rental property on its own schedule, basically. And what your responsibility is basically keeping track of everything on the income and expenses on a monthly basis so you don't forget anything. And my responsibility as the tax preparer would be to fill in the categories and then ask appropriate questions. And then if you wanted any additional like services like tax strategy or anything like that, you would that would also be like an additional service as well. But that's kind of the general gist of it at a high level in terms of like working with your accountant and all that. Pretty basic and boiled down. With regards to the house hack, you have to allocate the common expenses. So, you know, if you recall how we talked about how you have to allocate between like the rental and personal. For instance, if you have like mortgage interest, for example, of $10,000 and you're taking 80% of that, 80% of that or $8,000 can go on Schedule E, and then the remaining 2,000 can go on Schedule A, which is your itemized deductions. So that applies for utilities, property taxes, insurance, exterior maintenance, all that. So 2 examples here. So we just discussed one with mortgage interest. The second one would be, let's say you have a repair or maintenance item in your second unit that you're not living in, and it's a rental unit. You can expense that 100%. Whereas like if it's a common area, like the mortgage interest, it'd be about 80%. Next, we're going to talk about the sale of the property, kind of closing the loop on things. So this is obvious. This is a non-house hack example, just trying to keep it simple for y'all. But basically, upon sale, there's going to be like various tax consequences you have to account for. So the key items here are adjusted basis, which is the purchase price less any depreciation expense taken over the property or over the years. And then depreciation recapture, as you recall, is when you sell it, you have to recoup the depreciation and pay up to a 25% tax. So I think this is best like served as an example. So you have a property that you bought for $500,000 initially, all costs included. In year 10, you've probably taken about $150,000 in depreciation. So now your adjusted basis is $350,000. So it's $500,000 less what you've taken for depreciation, so $150,000. And now you're selling for about $700,000 after all fees and expenses and all that. So now in terms of the tax consequences and what's important, your gain on sale is going to be the $700,000, which is what you sold it for, minus your $350,000, which is now your adjusted basis. So of that $350,000, 150 of that will be taxed at whatever the lower of your ordinary income rates are, or 25%. For this math, I'm just going to assume 25%. And then the remaining is going to be taxed at the long-term capital gains rates because you've held it longer than a year. Right now, that's at about 15 to 20%. So now figuring out your total tax owed, it's going to be $67,500. So you're going to take that $150,000. That was the depreciation that's now getting recaptured, multiplying that by 25%, which is the rate, $37,500. And then you got your long-term capital gains portion of $200,000 times 15% or $30,000. So combining those two, you get to $67,500. The second way, or the second example we'll kind of go through is a 1031 exchange, which allows you to defer all the capital gains and the depreciation recapture, but there's certain limitations, and I'm not gonna go through like absolutely everything. But in terms of the accounting side, the gist of it is, in order to make the most of the opportunity, you got to trade up to a larger property. So, a few things to note here is that the replacement property has to equal or exceed the net equity you received from the relinquished property, what you sold. And then the total amount of cash that you're outlaying that you fund into the replacement property has to exceed the net equity you receive. So now getting into the definitions a little bit, the net equity. So net equity for the seller is the sales price, less the closing costs, less the mortgage principal paid off at sale. And we'll do an example of this in a second. And then for the buyer, it's the purchase price plus the purchase closing costs plus the new loan balance. So using that example that we had from the previous slide, the seller had $350,000 in mortgage. As such, the sales price, $700,000 minus the $350,000, they have $350,000 net equity. And that'll be important for this next slide. So continuing on with that example, with that $700,000 property, they need to find a property that they can afford that will have a greater net equity. So they had so they found a $1.5 million property that they said, okay, this is good. Now they put 25% down, leaving the mortgage of 1.125. So now you have 1.5 million less the 1.125. So you have 375,000. So that passes that test. And then it's also a higher it's a larger property. So it passes that test. So now in effect, from the previous slide, you're effectively saving the depreciation recapture and the long-term capital gains rate. So you'd be saving $67,500 in this example with this. And then the other item to note is that the basis of your new property is not the 1.5 million, it's reduced by the gain. So it's $350,000. It's $350,000 less. So it's 1.15 million because that's the gain that you deferred. Next, kind of going into the biggest mistakes that I see, not calculating depreciation correctly or not even having it on the return. So on Schedule E, there's just a line that says depreciation. So you would want to make sure like your accountant is figuring that out. So that's an easy way of doing it. And then there's also a different form called the 4562 that you can see if there's an asset that's been placed into service. Which brings me to the next point. So the date the asset's placed into service, some people like mistake this a little bit, but let's say you have a rehab and you have to clear out all the units. So it's 0% occupied. You can't place the asset into service because you're not renting it out at the moment. So let's say you buy it May 1st with the intent to rehab and it takes you 5 months to rehab. So now on October 1st, you're like renting it out and everything. That's the date that you can like place it into service and then therefore get the depreciation. So in effect, if you claimed it on May 1st, you would be improperly claiming the depreciation for 5 additional months. And you want to just make sure like that's right. Just depends on the facts and circumstances, but just something to be aware of. Another easy one is just forgetting expenses throughout the year. You just have to have a system of maintaining receipts. Personally, I just use a Google Drive and then I just keep track of it on a monthly basis because it's just too easy to forget unless you just have a really strong memory, of which I do not. And then in the year of purchase with real estate taxes, this applies for anybody, but in Illinois, you get a closing credit you get a closing credit for real estate taxes for the year prior. So I'll do a quick example. So let's say you get a closing credit of $7,000 on your closing statement for real estate taxes. Let's say you close in December 2020. And let's say your real estate taxes are $7,100. You can only, in the following year, you can only claim $100 as your real estate tax because you need to expend the credit before you're able to claim any deduction. So that's something that I see a lot of people, or some accountants that I see claim the real estate taxes improperly on that. So something to be aware of just so that you don't claim it and improperly get a deduction. For house hackers, this is something like at the beginning. So when you purchase your property and you're living in one unit, renting out the others, or doing bedrooms, whatever it is, you just want to make sure that the expenses are allocated properly, whether it's the common expenses, which we talked about, mortgage interest, utilities, property taxes, utilities, all that, and making sure that that's either allocated appropriately or it's 100% to that unit. Like any maintenance items that are specific to that. So that is that. Next, we'll talk about the life cycle of a flip. I know how many people are flippers here? One, anybody else? No? Okay. All right, you're alone, Rashid. So the purchase is the same thing as the rental. So if you guys want to go back, Chris and April will post these slides as well. But it's basically the same process as calculating that out. And then the rehab is when you want to keep track of all your expenses and everything. All the rehab expenses will get added to your basis. And then any other expenses we'll kind of talk about on this next slide here. So the main expenses, and again, this is not an exhaustive list, but it's something to at least look at here. Any like materials, labor, utilities, insurance, any like equipment rentals if you're doing like a pretty big rehab, any mileage to and from the property, any insurance that you incur, and then mortgage interest. I know it's pretty common to use hard money loans to get these. So you want to make sure you get an interest statement from the hard money lenders at your end, or maybe after the project is complete. You'll have to work with them to figure that out, because I don't believe they issue like the standard form that you get with the house. So something to be aware of there, so you don't miss out on a deduction or don't claim improperly. And then real estate taxes, we kind of talked about a little bit. They're kind of calculated as follows. Basically, the taxes paid during the hold period. So if you bought it in May and you held through September and you incurred some expenses there, that would be deductible. And then you would add the real estate taxes that you're paying as a closing credit to the buyer upon sale. And then you'd subtract out the real estate credit when you purchased it, basically. And then any staging expenses. So I know making it look nice and all that is important for flippers as well. So definitely important. And then other expenses that would not be like flip specific, or may or may not, but legal and professional fees, travel and meals, like an out-of-state investor visiting the properties or the subject property. And then any telephone, education, seminars. Moving to the travel a little bit. I don't know how many of you have like read any like Bigger Pockets books, show of hands. Okay. Have any of you like read like Amanda Hahn and I forgot the other guy's name, the tax books from there? Okay, a little bit smaller group. But
the tax one is a good one.
Yeah, the tax one's a really good one.
I just learned to hire you.
So there's this thing called the weekend sandwich. So like, let's say you're going to like the Bigger Pockets conference. I don't know when it is, but let's say it's 3 days and you want to go for like a 7-day trip. Let's say it's in like Nashville, Tennessee, and like you've never been, you really want to go and you kind of want to explore in addition to like going there for business. So what you can do is kind of space it out. So like you have like a weekend sandwich. It doesn't have to be the weekend per se, but basically any travel days are counted as business days. And then any like, let's say like the conference, that would also be a business day. So of that, you could maybe get like 5 business days, and then the remaining 2 or 3 or whatever days you can travel, or like you can travel around for. And that way you can deduct it, but you do need to have a business purpose. Like you can't just like say, I'm flying to like Charlotte, North Carolina, meeting up with some friends and counting that. It has to be like prearranged plans for business activities, viewing properties, meeting investors, talking to real estate agents, all that. So it has to have like a legitimate purpose. So, and then the sale. We'll go through a couple of examples, but basically you're just going to want to subtract out any fees paid out. So fees to real estate agents, recording fees, transfer taxes, attorney, all that. The next thing, we'll go through 2 examples here of sales of flips, and it's basically just going to be the same like facts effectively. So except the date is changed. So the purchase date that you bought it was 5/10/21. You bought it for 80, you put in 50, and then any other costs incurred with the project were about 8. So in effect, you're all in for 138. And then you decide to sell it. It's a pretty efficient flip. It takes about 4 months. And you sell it for 165 after all expenses, 175 on the sale, and then 10 on any sales expenses that were kind of mentioned in the previous slide. So in effect, you then have a profit of the 165 less the 138 that you're in. So you have $27,000 of profit. And the $27,000 of profit gets reported in 2021 because you sold it in 2021, which brings me to the next example of if you bought it, let's say 5 months later, October 10th, 2021, same facts, you bought it for 80, rehab 50, costs of 8, so you're in for 138, and then you sell it for 165 after all expenses. You still have a $27,000 profit, but in 2021, it's not reported as income because you didn't sell it in 2021. The IRS considers it inventory. But in 2022, you'll report the $27,000. And then in terms of the reporting, just to make sure that you guys like see it from your accountant and you kind of have like a check on them, they're generally reported on Schedule C as part of your individual tax return, as part of your 1040. But I know some people have like single member LLCs, which we'll get to in a minute, and you can elect to like have an S corporation. If that's the case, you'd file an 1120S, which is the S corporation tax form. And just to reiterate, income's only reported on the property sold during the year, and then houses are considered inventory. The other items to note here is if you're kind of like doing this for like full-time or even like on the side, you're going to need to pay estimated payments most likely. So your job, let's say you have a W-2, your job withholds the money for you. There's no one to do that for you. So you need to pay into the government, whether it's the federal or state or federal and state, so you avoid any underpayment penalties. And you'll want to work with your accountant to figure out what that tax impact will be, just so that you're kind of staying compliant and avoiding any underpayment penalties. Generally, I'd estimate though anywhere between 40 to 55%, because you have 5% for Illinois, 15.3 for social or self-employment tax, and then depending on your income tax bracket, it could be as low as maybe like 12%, but it could be as high as 37. So it just depends where you are on the income spectrum, but I'd say 40 to 55% is a good number to kind of shoot for. Now we'll kind of get into some of the advanced real estate topics. So real estate professionals have a pretty big status with regards to the IRS. There are additional requirements that you need to follow. But the biggest benefit, or the main benefit that people cite, is you can offset your passive losses from real estate with ordinary income. So for instance, let's say you have one spouse working and the other not. So you have $300,000 in income from the W-2, and let's say you have $100,000 in losses from your real estate, whether it's a syndication or whether you're the GP or whether it's just your own real estate that you have for yourself. In effect, instead of paying tax on the $300,000, you'd be paying tax on the $100,000. So you'd be paying tax on the $200,000. So $300,000 minus $100,000. You do have to qualify for this. So there's a few qualifications that I want to run through. Have to have 750 hours in qualified real estate professional activities listed below. Most people would probably follow under the rental activity that isn't passive, like being a GP on a syndication or self-managing, or potentially like acquisition conversion, or like some people might be a realtor as well to save money if they're flipping. That would be another example there. So it just has to be like one of these. And then you have to spend more time in the real estate than any of your other jobs combined. So if you work 1,500 hours in your real estate, and then you work part-time for 750, and then you work another part-time for 600, you're good. But if you work a full-time job, it's going to be pretty hard to qualify unless you're working like 80 plus hour weeks. In the IRS, like if you're a W-2 like employee, it'd be like 52 like weeks times 40 hours, even if like you're not technically working those hours. So the other thing to note is it just has to be met by one taxpayer. It doesn't have to be met by both, but you do need to like materially participate in the properties that you own. So it's basically defined as the taxpayer being involved in like some regular continuous way, and it has to be like substantive. And with regards to the documentation, you're going to want to keep a time log to substantiate the time on a daily basis. If you don't do any stuff that day, you don't need to log it, but you just want to make sure that you document it and have things like pretty tight, because it is like a pretty significant, or it can, like if it's in the event of an audit, they can always like disallow like losses that you took. So not to say be afraid, but it's always best to have more documentation, not less documentation. So the more documentation, the easier it is, the more you have on your side. The next one is cost segregation. This will probably apply more in multifamily buildings than single family, but the general gist of it is you're breaking the building into its component parts. So for instance, appliances, land improvements, all that kind of get broken out. So you can take that depreciation sooner than you otherwise would have, because otherwise on a residential property, it's over 27.5 years. Whereas with some, it could be 5, 7, or 15 years. And with bonus depreciation, it could be even over a shorter time, because what bonus depreciation allows you to do is write off things faster for asset classes that you otherwise would have. And basically anything that has a useful life of less than 20 years, which again, you can look up the useful life schedule at the IRS, but you can take 100% bonus depreciation through the end of 22, and it phases out like 20% each year thereafter. So for instance, like 2023, it's gonna be 80%, 2024, it's 60, and so on and so forth until it kind of tapers off. But you basically get like a pretty big benefit if you do this cost segregation study, and I'll kind of outlay that in example, or explain that in example soon. The other thing to know about this is that you don't want to do it yourself. You can't just say like, this appliance is worth 10,000, this flooring is worth 25. You want to get a qualified person to do it, and there's 13 like key elements that you need to be aware of. And I listed that out in the link in my presentation, which you guys will all have access to. So a couple of examples here. So cost segregation, bonus depreciation. This is a non-real estate professional, just to kind of illustrate the points. So let's say you buy a property in August, you buy it for 1.5 million, 30 units. I don't know if that's feasible now or not with how much the market's kind of ran up here, but you discuss with your CPA about doing a cost segregation study. Most CPAs probably won't have this in-house, to be honest. So they may refer you to a cost segregation expert, or you could reach out to people on Bigger Pockets to find one. There's certainly quite a few in the forums from what I've seen. And so after that, they determine after breaking the building out into its like component parts, you have a 5-year, of that 1.5 million, you have a 5-year life of 100,000, 7-year life of 150, 15 of 150,000, then the rest is just like building, which would have been depreciated like normally over 27.5 years for 800,000. And then land of 300,000 to kind of like round things out. So before cost segregation, assuming it's just 80% building, 20% land, it would just be that 1.2 million, which is the 1.5 million less the 300,000, multiplied by the 5 months that you could depreciate it over, divided by 12, which is the number of months, and then over its useful life, and you would get $18,000 of benefit basically. However, with cost segregation and bonus depreciation, if you do it in 2021 or 2022, you could in theory get all the 5-year life, all the 7-year life, and all of the 15-year life, all in year 1 of that, plus most of what you already would have gotten from the other, from like the other like 27.5-year life. So in effect, the difference is like $400,000 because you're able to just push that off in year 1. Something to be aware of is your depreciation will be a lot less in future years, but generally people want the upfront depreciation benefit, and especially if you're syndicating or whatever, it just makes sense to kind of do it. So something to be aware of there. So you may ask, like, what happens to the loss if you're not a real estate professional? So it ends up being rolled into future years unless you can qualify for the small landlord exemption. So there's a few qualifications with this. You have to be under 150,000 adjusted gross income. So it's basically like everything that's like wages, interest, Schedule E stuff, less a few like certain expenses like HSA, IRA. And then you have to actively manage the properties and then own at least like a 10% interest in that. And even though, like, let's say you're an FHA buyer owning 5%, you still own like 100%, like you're not sharing it with anybody. So that would be an example there. And it basically allows you to take up to $25,000 depending on like your level of income, kind of at a high level. And then the second example, let's assume the same facts. Let's assume the real estate professional has 600,000 in income before this. In effect, you would be able to deduct all of that depreciation deduction all in year 1. So you would get the 418,000 taken off. of the 600,000, and you'd be paying tax on the 182,000. So it's just a pretty big difference if you acquire like one big property. And the same would apply like if it's a bigger property and that's their share of income from like a real estate partnership or what have you. The last thing I wanted to touch on is business entities. So single member, and this is only for tax purposes, not any legal or anything like that. But the single member LLCs are disregarded entities for tax purposes, meaning that the information basically flows like to your 1040 unless it's made to be like an S corporation, which you can elect with like a special form. The multi-member LLC has a separate tax filing requirement. It's the form 1065. Members basically get their K1s, which is their share of income or loss, and those K1s then get reported on your 1040. So if you're an investor in a real estate partnership, just wait until like that comes through. You may have to extend or extend your returns a little bit, but it's better to extend than to amend. Then with the multi-member LLC, and this is what's nice about the LLC, it's pretty flexible. You can elect to be an S corp. Same thing with the single member LLC with a special election. And then with the S corp, you can sometimes use like I would say like a good amount of time it's used for like brokerages or flips or something like that. Generally not used for properties. So this also requires a separate tax filing. It's the form 1120S, S for S corporation. And then the income, it's the same deal as the multi-member LLC where the income flows directly to the owner. The owner will get a K1, which is their share of income or loss. And then they'll file that on the 1040. However, one thing to be aware of here is that the owner has to pay a reasonable salary, meaning they have to get a W-2. And then with that comes like additional filing requirements for like payroll taxes as well, because then you have to file payroll tax returns. So you want to kind of discuss this with your accountant to see if it makes sense and all that. But if you're flipping a lot or something like that, it may make sense in that instance to go with that just to save some taxes, especially with self-employment. And then the last one would be the corporation. It's typically not used for property as well. It's taxed on the profits and the dividends. So the tax on the profits is 21% right now because of the last tax legislation change. And then the dividends would be taxed at your rate, which is probably 15 or 20%. This is an additional tax filing as well. It's the form 1120. And there's no other tax forms that need to be filed unless you're declaring dividends and paying those out to any investors, which would be like the 1099 DIV. So like if you have like a brokerage account with like TD Ameritrade, Schwab, similar to that, is when you would have to just like mail those out to the investors. So to kind of sum things up here, I have about 6 main takeaways. If you don't take anything else, in the year of purchase for the rental property, you want to make sure you get your basis right. Otherwise, you may be leaving some money on the table. And then with regards to the documentation, it's ultimately up to you to keep it and maintain it. I would keep it for about 7 years. Fortunately, like Google Drive and those types of programs, like it won't take up too much space or too much or anything like that. So just make sure it's kept in a safe place and that you keep your records on a monthly basis. Flip income is treated or is taxable income unless you like create like a corporation, like an S corporation. So basically just make sure you allot money for taxes in the event of a profit. Real estate tax professionals get to take their losses against their active income. And then cost segregation can be a powerful tool to lower your tax liability in the right circumstances. It may not make sense as a high income earner, but it may make sense if you're a real estate tax professional. So that's something you'd want to talk to your accountant with before doing it, assuming you have control to do it, i.e. like you're not in a syndication. So then the other like main takeaway is just creating entities may create like additional tax filings, as we discussed. Talk to your accountant to make sure all the appropriate forms are filed, just so they understand like the circumstances and all that, so you can make sure, like you can be sure that everything is just filed correctly and on time, and you don't have to pay any penalties. So that's my presentation. Let's open it up for questions. Thank you.
All right, Aaron, thank you so much for that presentation. We're going to open up for Q&A. We're going to go ahead and start. I think we have a couple questions here from our Zoom meeting, so we're going to go ahead and have Aaron answer these first. So the first question that we had here is, does a condo owner have to report depreciation on Schedule E?
Does a condo
owner have to report depreciation on Schedule E?
Assuming they're like, can we
clarify that question?
I'll ask Stephanie to verify. What did you want her to answer?
basically like they own it for like rental property purposes?
Yes.
Yeah. So yeah, you'd be eligible for the depreciation deduction, but you'd also want to allocate between building and land. Generally speaking, like you're going to have a lot more building than you are land. But if you think about it, the land that the condo is built on has a value. It's just distributed separately to like all the like members. So you just want to make sure that that's taken care of, because I've seen it where it's not. It's not the biggest of deals, but you typically want to have that on there to make sure it's just done right.
And one more question here we have, what evidence do you need to support business travel expense claims?
Yeah, so to support the business travel expense claims, I mean, you just need to make sure, going back to the first slide, that it's ordinary and necessary within the course of business. Seeing as though real estate investors and other groups like to meet for networking and stuff like that, that would be a legitimate business purpose. And then probably just documenting what things you learned. Just taking good notes, and then like on the receipts, for instance, like on your like meals and stuff like that, maybe discuss like who you talk to or something like that. Just the more documentation, the better.
All right, does any of you guys have any questions you guys wanted to ask? Feel free to raise your hand.
Are the meal deductions 100% this year?
Yes.
Wait, can you repeat it?
Oh,
April asked, are meal deductions 100% deductible this year?
yes, they are. Yep.
All right.
On the cost segregation, is that an alternative to the 27.5 years depreciation? It's a way of subdividing the typical 27.5 year into different allocations that speed up the process, so you don't have to wait 27.5 years.
Repeat the question.
Yeah.
Press repeat.
So basically the question was, does cost segregation allow you to like speed up depreciation? And the answer is yes. And it's typically like the way the IRS like wants you to do it anyway. So yeah, in effect, yeah, it like really speeds up the depreciation potentially, depending on the building, building type, all that. And especially, I mean, if you're getting into commercial building too, that's depreciated over 39 years. So even more like incentive to take accelerated depreciation with that, with using the cost segregation study as your backup, because without it, you don't have any backup. And the IRS likes to have backup.
There's still a portion of it that's the building itself.
Yes, correct. Yeah. Yeah. Yeah, for sure. So it would just depend on the building itself, but you may be able, like, instead of like 100% being allocated to the building, you may get like 70% allocated to the building, or 60 or something like that.
Juan, you had a question?
Yeah, I have a question. So, question number one, how do you, when you're trying to determine depreciation, how do you determine the value of the land?
So he asked, when you're trying to determine depreciation, how do you determine what the actual value is of the land?
So typically the best way, there's two ways, is there's the appraisal sometimes that will show it, that breaks out the building and the land, or the value of the building and the value of the land. And then the other way that's like the most common is like the assessor's website. So like Cook County, for instance, has it, where you can see like pretty much what the value of the building and the land is. So those would be like two ways if you're kind of like looking to DIY it. Otherwise, you could reach out to like your accountant, but like it's pretty accessible information, I would say. Jeff?
Yeah, so we have the recapture of the depreciation, right? Doesn't matter if you go backwards in time whether or not you did cost segregation, or I guess whether or not. Doesn't matter. Does the recapture process or the details of recapture, is it impacted by whether or not you did cost segregation? Does that make sense?
Kind of.
So if you don't do cost segregation, you're going to get something, some recapture happening.
Yeah.
After you do cost segregation, is it the same recapture?
So basically the question relates to the depreciation recapture, whether you do the cost segregation or not. I mean, basically you would just have more depreciation to recapture in that instance, if you're doing the cost segregation study as compared to not, if that kind of makes sense.
So the math is kind of the same.
Yeah.
Just giving it a different amount.
Yeah, and you're also getting like the time value of money too
Sure.
with that as well, where $1 today is worth more than $1 in the future. So if you can delay that out several years or take it all in year one and then invest that into additional improvements or something like that, that's kind of where you would see it. April?
If you were to sell though, you would have to pay back the depreciation that you did not technically take, correct? Yeah, so if I depreciated it, with the cost segregation and I sold it at 5 years.
Yep.
But I took like an upfront depreciation.
Yep.
Faster, I would have to pay that back, correct?
Yeah, so the question was, if you take the accelerated depreciation, you would have to pay it back on the back end. The answer is yes, unless you do like a 1031 exchange. And especially on if you're in a syndication or anything like that, you would need to kind of get like the investor like buy-in to do a 1031 exchange. It's not impossible, but if you have like 20 investors, they probably all have their own separate agendas and what they want. So
From my experience on that, you need to set that up in the operating agreement
Up front.
yeah, that's a good point, Jeff, to set things up like in the operating agreement and get that like initial interest initially. With that being said, those like facts and circumstances could change like 10 years down the line. That investor may need money. But would there be a way like where it's like kind of legally binding in which to do that, or like?
Oh, that's a great question. I think in the operating agreement, I think depending on how to write it, you might have a lot of leeway to leave those options for the future 10 years later.
Mhm.
Where if someone's in a bind like that, maybe the members could come to an agreement.
Yeah.
And they wouldn't be forced into what they planned 10 years earlier.
Yeah, totally. Any other questions?
Any other questions online? Yes, one.
So in regards to cost segregation, so my guess is that it's kind of expensive, right, to have somebody do the assessment. So does cost segregation ever make sense in smaller, like I said, 4 or 3 units?
It depends. Yeah. So basically the question is, does cost segregation make sense in the 403 unit? It can. You would want to talk to your accountant about like the specific like facts and situations. But I mean, if you have a $500,000 property, you could potentially accelerate a lot of that depreciation like up front, which is nice. The question would be like, can you take it now? Because like if let's say you're over like 150,000 for the year adjusted gross income, you wouldn't be able to get any benefit. You just roll it forward. So it's up to you to determine like if that's a worthwhile cost. Something to also consider is that that cost is deductible as well because it's a business expense. I don't know exactly how much it would cost, but it can make sense. And like, let's say you're 100, like you make 125,000 each year as like a single person or even like married, you can definitely like get some of that benefit. But I'd say like generally speaking, like it just like depends on the facts and circumstances on the situation.
Anybody else? I actually had a question for you, Aaron.
Okay.
So as far as depreciation recapture,
Yep.
you had mentioned that the tax on that depreciation recapture, if you choose not to go ahead and do a 1031 exchange or something similar, can be up to 25%.
Yep.
What determines that rate?
Yep. So what determines that rate is basically your income for the year. So let's say you make like 70,000, and then you make 100, or let's say you make like another like 300,000 with this like recapture, you'd get pushed up into a pretty high tax bracket pretty quickly. So instead of paying, let's say you get bumped into like the 32% bracket, it's just capped, but it's basically just based off the income of or like what your income is for the year plus whatever additional items there are with the property that's sold.
All right, so if we don't have any other questions, we're going to go ahead and start our breakout rooms and go ahead and start our networking. What I do want to first say is if everyone can please just give Eric here a round of applause for being an incredible host for us. He allowed us to immediately go ahead and pick up right where we left off last year in October when we were hosting our meetups over here. So thank you very much, Eric, for hosting us. And do us all a favor. He's also a fellow real estate investor, and he's also a small business owner. So go ahead and support us. Please go ahead and get yourself a beer if you can. We don't charge you anything for this, but if we can support Eric, we would love to keep coming back here. So go ahead and do that. And also thank you everybody virtually for attending. We're going to go put you guys into breakout rooms. We're going to turn Aaron's laptop around because what we would encourage you guys to do is there are a lot of people over here on Zoom that are not even here in Chicago. So if you want to have an opportunity to network with people outside of Chicagoland proper, we encourage you guys to go ahead and, kind of make your way over to this table too.
Tell them to turn on their cameras.
Yes, and everyone who's on Zoom, go ahead and turn on your cameras. You don't have to be shy.